Last month, the Chinese government announced a raft of stimulus measures to try and reboot the domestic economy, having spent the last few years stubbornly refusing to do so. This shift sparked a wave of euphoria amongst foreign investors, who piled into Chinese equity markets on the assumption that this was the beginning of a wider policy pivot. Unfortunately for these guys, in the past few weeks, the CCP have signalled that, despite some more worrying deflation data over the weekend, further stimulus is by no means guaranteed, sparking another sell-off in the stock market. So in this video, we're going to take yet another look at China's economic crisis, why the most recent stimulus has fallen short, and what might happen next. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. So, as we've argued in previous videos, the root cause of China's economic crisis is plausibly the fact that consumption accounts for a disproportionately small share of its overall GDP. Essentially, GDP is often defined as the sum of four things: government spending, business investment, household consumption, and the difference between exports and imports. Household consumption makes up a disproportionately small fraction of Chinese GDP, something like 40%. In practice, this means that your average Chinese person doesn't really buy or consume that much stuff, and the Chinese economy is instead mostly driven by exports to foreigners. The basic reason for this is pretty simple. Through a variety of mechanisms, including an undervalued currency, China essentially underpays its workers, keeping them poor and keeping China's exports competitive. Anyway, all the elements of China's wider economic crisis interact with this fact. The deflationary crisis, for example, is in part because Chinese consumers just don't have enough disposable income. The property crisis has been partly caused by the fact that Chinese households don't have enough money, so have to take out massive and apparently unsustainable mortgages. Similarly, China's youth unemployment rate, which the CCP actually stopped publishing data about because it got so bad, is in part a story about educational inflation. But it's also because China's domestic economy doesn't have the strength to create enough jobs. Broadly speaking then, China always had two ways of responding to its economic crisis. One, revert to the old playbook and double down on investment and exports by building even more infrastructure and further subsidizing Chinese industry. Or two, it could increase consumer demand, presumably via some sort of stimulus package for households or by improving China's social safety net, because households spend more if they don't have to save up as insurance against unemployment or illness. For a long time, it looked like the CCP had committed to option one, and Xi himself started talking about new productive forces as his preferred remedy for China's economic woes, which basically mean doubling down on Chinese industry, but with a renewed emphasis on high-tech and strategically significant sectors like electric vehicles, semiconductors, and AI. However, after months of stubbornly refusing to change course despite some pretty bad data, late last month the CCP finally caved and announced a dramatic stimulus package. Much of this was directed at the housing sector. Alongside a reduction in mortgage requirements for second homes, the central bank also cut the reserve requirement ratio for banks, essentially freeing up cash for banks to lend to prospective home buyers. The new financial sector watchdog, the National Financial Regulatory Administration, also announced a plan to recapitalise the banking sector to encourage more lending, and there was targeted support for the stock market, with an 800 billion renminbi fund distributed for Chinese equities. This triggered a wave of euphoria in Chinese stock markets. Having fallen steadily since really early 2021, China's blue-chip CSI 300 index of Shanghai and Shenzhen listed companies jumped by 32%, and Hong Kong's Seng index rose by about 25%. At the same time, foreign investors poured billions of dollars into exchange-traded funds or ETFs focused on Chinese equities. Now, at first glance, this stock market mania might look like a bit of an overreaction. Overall, the package was actually a lot smaller than previous efforts. For context, it was a lot smaller than China's stimulus packages in 2020 and 2014, which both amounted to about 4% of GDP, let alone its post-2008 stimulus, which amounted to about 25%. However, a lot of this enthusiasm was driven by an assumption amongst investors that these measures were just the beginning of a wider U-turn, preceding a more expansive stimulus package rivaling what we saw in 2014. Unfortunately for investors, two things have happened since then that don't bode so well. First, there was a much-anticipated press briefing by Chinese officials on October the 7th, where the CCP were expected to announce another 2 trillion yuan's worth of stimulus, with half going to debt-distressed local governments, and the other half going directly to households. This isn't what happened. While the CCP said they would be borrowing more money at the national level, they didn't give too many details, and they definitely didn't commit to another 2 trillion yuan package. In the immediate aftermath, Chinese stocks slumped, with the CSI falling by about 6% and the Seng index falling by nearly 10%. Then, over the weekend, China released its latest monthly inflation data for September. China's Producer Price Index, which basically measures the cost of stuff coming out of the factory gates, fell by 2.8% year-on-year, the steepest decline in 6 months, while the Consumer Price Index increased by 0.4%. While 0.4% might not sound that bad in the Chinese context, after all it's better than outright deflation, it was still below forecast, and the numbers were buoyed by a sharp uptick in food prices, thanks to increased demand before the Golden Week holiday in early October. Now, all this data is bad for 2 reasons. First, it suggests that the current stimulus isn't going to be anywhere near big enough to rebalance the Chinese economy towards domestic consumption. But second, it suggests that the CCP don't want to. These numbers won't have been a shock to Beijing. They have a good sense ahead of time about what the monthly inflation stats are going to look like, and other data in the past few weeks have looked equally gloomy. In late September, for instance, data was published showing industrial profits down 17% year-on-year, and Chinese consumer confidence has continued to plummet. This means that Beijing knew, and still knows, that the deflationary crisis is worse than expected, but is nonetheless withholding larger stimulus. This, in turn, suggests that the most recent bout of stimulus was just to stabilise the economy, rather than the beginning of a wider reorientation, as investors originally assumed. This is probably because Xi, fairly, worries that stimulus would just reflate China's enormous housing bubble, when he apparently wants to rebalance the economy towards technology-intensive manufacturing. Similarly, many CCP officials think, in retrospect, that the stimulus introduced in 2009 and 2014-15 was just too big. After all, it was after 2008 that local governments really started loading up on debt, and the stock market boom and bust in 2015 spooked investors off Chinese equities for years. Nonetheless, whether the CCP can walk this tightrope of stinging on stimulus without triggering a Japan-style deflationary crisis remains very much an open question.